नमस्कार दोस्तों, स्वागत है आपका द एन शो में। और आज हम बातचीत करेंगे Q4 अर्निंग्स पे इम्पैक्ट की और साथ ही FY27 जो अब शुरू हो चुका है उस पर क्या इम्पैक्ट होने वाला है। जो वॉर चल रहा है वेस्ट एशिया में, बहुत कुछ बदल रहा है क्योंकि ऑयल शॉक पूरी इकोनॉमी को लग रहा है, इवन पूरे वर्ल्ड को लग रहा है। और एक तरीके से कहें तो इकोनॉमिक वर्ल्ड वॉर चल रहा है ये। उसका इम्पैक्ट क्या हो सकता है और लास्ट क्वार्टर के एक महीने में जो सीवियर इम्पैक्ट हुआ है उसको किस तरीके से अर्निंग्स पे हम लोगों ने देखा है, इस पर हम बातचीत करेंगे। मेरे साथ एक बहुत ही स्पेशल गेस्ट है, मिस्टर मिरेन लोढ़ा। ही इज अ सीनियर डायरेक्टर इन क्रिसिल, and CRISIL has come out with a report which shows very clearly that Q4 has some impact, but Q1 27 and rest of the year will have major impact on earnings, especially in margins, if not in revenue. And it is just for a Q1 estimate. Rest of the year we'll see how it can pan out because the war is not closing at off now. And if it continues, then things will go haywire. So very good evening, Miren. Thank you so much for joining the N show. And very interesting report CRISIL has come out. So first, you briefly tell me what's in this report. Then we'll discuss what is going forward.
Sure. Thanks, Neeraj. Good evening, and good to be on the show. See, I think the entire West Asia crisis, it's impacting everyone worldwide. Your energy prices are going up. There's a supply shock issue for certain commodities. Supply chains are getting impacted. If you see, let me speak about India specifically. I think we've analyzed the quarterly financials for the listed universe. Our sense is, for Q4 of 26, which is the quarter which has gone by, margins are estimated to have declined by about 50 basis points. While this still seems okay, bear in mind this was also the period where you had disruptions only for 1 month. Also, the impact starts getting more pronounced as the inventories fade out. You have new stocks getting replenished and so on. So our expectation is, of a bigger impact going forward. So for instance, in Q1 of this fiscal, which is fiscal 27, we expect margins to decline by almost 100 basis points. Just to give you a sense, Neeraj, this will be the, possibly the lowest quarter in terms of margins in the last 12 quarters. So that is the impact that we are seeing going ahead.
Okay. So you're saying last quarter was just a 50 basis point impact. In the next quarter, it could be 1% or even more. So tell me, because the current quarter, which is April, May, June, we will have full on impact. There will be no inventory impact or any pipeline impact or anything else. It's a complete full impact. So do you see it could be very severe in second line impact and third line impact, or only it is limited to headline impact right now?
Okay, so when you say headline, I am assuming you mean revenue versus the operating profits and net profits. Correct. So yeah, I think revenue growth will still continue. Neeraj, I think the composition of revenue growth will change. We still see 8 to 9% revenue growth happening, which is not very exciting, but not bad either. Just to give you a sense, the decadal average revenue growth for corporate India, at least the listed universe, has been around 9%. So it's more or less in line with that. The challenge is, for the past 2 years, this entire growth was largely volume driven. But now with this entire West Asia crisis, realization increase will be a large part of this revenue growth. Obviously the energy prices have gone up, but it's not limited to only the higher energy prices. There's an increase in, if you see metals, all key metals, aluminum, copper, steel, the prices have gone up. chemicals, the entire polymer value chain. Now that's very important. So if you see, for instance, polyethylene, which is the most common packaging material, there the prices have gone up by almost 50% in the last 1 month. Now this directly then impacts the FMCG companies, and we also seeing some companies, leaning on shrinkflation. So shrinkflation is nothing but FMCG companies reducing the packet sizes to pass on the price hikes. So I'm saying, as you see, the price hikes will drive the revenue growth, and you will have more and more price hikes happening across the entire spectrum, and not limited to just the energy commodity world.
Okay, so we are hearing that in Firozabad or Morbi or Coimbatore, there are some units are closed, laborers are going back because there is no work. So this impact could be more deeper in terms of job losses, in terms of production, in terms of other economic activities. So in compound, the impact will be more severe, we are assuming right now.
See, I think one thing is clear: as the conflict continues for longer, the impact will keep getting magnified. It will not be linear. Yes, I think some of these sectors, you've seen production getting impacted, but I don't think it is at a scale where, there's mass scale unemployment. I don't think that's really the thing we are worrying about now. But I think the supply chain disruptions, cost increase, and hence higher inflation, they are all happening right now. So right now, I think these are the bigger worries than really, the mass scale unemployment part. I don't think we've entered that phase, or we are anywhere close to getting into that phase right now.
So largely going forward, we will see inflation-led growth rather than volume-led growth, number one. Number two, if it continues for next 3 quarters, which it seems, because it has become military war to economic war. There is nothing happening in terms of military, but economic war is continue. So if it goes for 2 3 quarters, 6 7 months, 8 months, then what will be the impact? And are we ready to absorb that shock?
Uh, See, that's this continuing for 6 8 10 months, in my mind, is a low probability scenario, because I think nobody is ready to absorb the cost of the war. But if it continues, I think it's a very difficult scenario all of us will be in. Just to give you some sense on this, so if you see IMF projections right now for global growth, IMF, I think in the latest update, they are expecting somewhere around 3.1% growth, which is already a reduction vis-a-vis their previous estimate. But I think this still expects the conflict to get over in a reasonable time frame. In that specific scenario where they are expecting crude to stay around $120 $130 per barrel for the year, they expect growth to come down to 2% now, which is significantly low compared to anything that we've seen in the recent past. More importantly, I think this impact will not be symmetric. So countries that have a higher dependence on global seaborne crude and LNG, they will definitely take a bigger brunt of this. Whereas countries which are more internal when it comes to their energy requirements, who have some inventory positions, they have possibly some shelter buffers, they'll be less impacted. So you will also see a world where the growth is more polarized. Finally, I think the last impact, which not too many people are talking about right now, I think is the one fallout could be that there will be increased protectionism if this conflict continues for very long. Governments will start prioritizing domestic security, or domestic security over global efficiency. So you could see, export restrictions, quotas, licensing requirements, all of those elements playing out, which could be, sort of detrimental to our national interest. Also, the timing couldn't be bad because the government is trying to promote domestic manufacturing, domestic exports through the PLI, and the various other interventions. So, if this conflict continues, it could also be a drag on our export and manufacturing ambitions.
So, Miren, let me paint you the picture, because government has already taken the shock of 1.4 lakh crore when they removed the excise on oil. If we see the landed cost of crude, which is $120-130 right now, forward price is definitely 110, but landed cost is 130. So earlier our estimate was $70-75. Every company, even RBI, was estimating that. Now it is just double. So the impact will be permanent. If war, even if war stops next day tomorrow, then only making all the supply up and running will take lots of money and time. So it will simply take 6 to 9 months. That's my estimate. So during that period, huge money will be spent. I think 2-3 lakh crore we need extra. That is, we don't have. Already we are in 7% repo rate. And it's a bond yield, 7%. So borrowing is difficult, currency is weakening, FDI is almost zero. So how they will manage? If they go for licensing rather than quota system, all that, it will be detrimental. Then Moody's will be right. Below 6% we can go.
Yeah, so I think 2-3 things. I think Neeraj, all depends on how long the war prolongs. Right now I think, as you said, landed cost is around 110-120 depending, and it moves daily. So I'm not getting into that, but it's in that range. Even after the conflict stops, and let's assume for the moment it stops in the next few weeks, you will not see crude immediately coming back to the pre-crisis levels. So it could gradually come down, but there's definitely some capacity erosion which has happened, and hence you will see crude coming down to possibly 80-85 by the end of the year, but still not to the pre-crisis levels, which was somewhere around $65-70. So yes, the on a full year basis, there will definitely be a fiscal burden. How does the government tackle? See, it's very difficult to answer at this point. We'll have to wait and see what are the measures. See, the government has got few levers. I think to start with, if you see, compared to the previous periods of crisis, this time, at least from a fiscal perspective, we are in a much better position. We've seen our fiscal position correct, sequentially over the last 3-4 years. Current account deficit is again, while it will definitely go up, right now it's comfortable, within the RBI comfort zone. It was around 0.8 last year. Even with this, I think we expect it to be 1.5%. So we've got some elbow room, assuming the conflict's over in the next few weeks. Obviously, if it prolongs, then the government will have to figure out ways to either pass on through higher fuel prices, or there could be some reduction in fiscal spends, and we'll have to see what spends take the axe. But depending on the fiscal response, the things could change on the ground.
Miren, you see demand destruction going forward?
Yes. So I think, as I said, as the conflict prolongs, the impact will keep getting pronounced. So, inflation starts playing out. Last 2 years, if you see, especially last year, I think the inflation was abnormally low. We've had back-to-back healthy monsoons. Commodity inflation was low. So CPI was only around 2.5%. Our expectation right now is of CPI, consumer price inflation, being around 4.7% in the current fiscal, which is higher compared to our previous estimate, obviously because of the crisis. But this has further downside risks. So one is We are just talking about how government has till now at least kept the retail fuel prices stable. Now that insulates the entire value chain. But if you see, if diesel prices were to go up, then you will see the impact playing out on, the entire logistic cost. And then you have, cement prices going up, construction cost going up, your entire cold chain, e-commerce, everything, FMCG, all the sectors see an increase in cost. It depends on whether we reach that stage. Only silver lining I see is if I take your memory back to the Russia-Ukraine conflict, we had crude being at about 110, $120 for almost 2-3 quarters. We didn't see the government increasing the retail fuel prices in any substantial way. But if that happens, then we see definitely there's a demand slowdown. You will see an impact across sectors. And I think one more thing which possibly Neeraj I'll just call out as another risk is the likelihood of a below normal monsoon this year.
Mhm.
We've had good monsoons, supportive monsoons for a fairly long period, I think 5, 6, 7 years.
Yes.
Now, this is just the bad time. It's coming at a time where you've already got global headwinds. If that plays out, Andy has already called it out. If that plays out, I think, we be in for a challenge.
On a lighter note, 26 is not astrologically good year because there are lots of bad news. Even El Nino is there. Monsoon is not good. Heat is so much. So, your inflation CPI target is 4.7% for this FY27. How much you have
Yeah,
increased?
sorry.
How much have you increased?
We were somewhere around 4%. We've taken it to 4.7%.
Okay, so further chances to increase because real impact will start coming from Monday onwards or Tuesday onwards when oil prices will be high. That's for sure, I
I
think.
don't know. You are baking it. I mean, we'll have to wait and see what the government stance is. But yeah, I mean, we've not factored in right now. This does not factor in higher fuel
That's important.
prices. Yeah, if that comes, then this goes up further.
So I got the answer because you have not factored in this price hike, which is in my mind very, very, very much coming. Then it will be again revised. Number one. So now you tell me if you see the last credit policy announcement, the RBI governor was so comfortable. He was not very much worried. It seems like, but as of now, if we see the inflation rising is a supply led, not demand led.
Yeah,
So rate hike chances are very dim. And if they hike the rate, that will be again detrimental. So
yeah.
what are the options with the central banker? Mr. Malhotra, what will they do?
See, I think as of now, I don't want to ring the alarm bells on the inflation and the rate hike side. Uh,
Mhm.
in fact, at 4.7% also, I think it's still well within the RBI tolerance band of between 4 to 6%. So I don't really think right now there's a need to go and uh, do anything on the rate front.
Mhm.
We'll obviously have to wait and watch. I mean, it all again goes back to that same point on how prolonged is this entire thing. But at these levels, I don't think rate hikes should be. At least we are not baking in a rate hike in our base case scenario for this year.
Okay. Do you believe government should not very much stick to the fiscal deficit target, which is a 4.3? They should relax it because the situation is very abnormal.
Uh, Neeraj, does not matter what do I think. I mean,
No, 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 no. I
there are a
think
lot of.
it means you are an economist, so you can just
No,
suggest,
I'm not
you
an
can just
economist, but
analyze
yeah,
the
I
thing.
think.
I
Yeah.
understand.
So,
I'm not saying.
uh,
Yeah.
no, I think, uh, I mean, there are obvious pros and cons of everything. The path that government has taken so far is, of fiscal prudence. We've seen, I mean, in, extraordinary times will require extraordinary measures. So in even during the COVID phase, we've done some relaxation on the on the fiscal side. So I mean, at all, I mean, it's a government call. I mean, I don't want to preempt
You
and
know,
put
yeah, analysts and economists are very smart people. They speak very stylish way, so people can understand and get the takeaway. Okay. So, lastly, please explain me. Please make me understand. What sectors do you see will be maximum impacted? Now, every sector I see there is impact. Even I see IT is badly impacted by the oil because 56 countries are dependent on the oil economy, and if they are going
yeah,
down, then IT sector cannot go perform well. We are blaming currency and AI and all this, but the real reason is oil also. So,
yeah.
please explain me which sector going to be very much affected in this scenario.
No, I think you rightly said, Neeraj. I think large part of corporate India, if I exclude BFSI, will see
Mhm.
margin compression. And I'm talking purely from a margin perspective right now. Uh, the sectors which will have the highest impact are the sectors where possibly they are dependent on crude and crude derivatives or natural gas for their inputs, uh, and also sectors which have limited pricing power. So there's a long list there. I can go on. So airlines, ceramics, chemicals, fertilizers, tires. I mean, all these are sectors which are right there at the top in that list. Then you also have sectors like possibly cement, pharma, where the impact is not as pronounced as possibly a ceramic or the airlines, but they'll still have a very substantial impact in terms of their margins. Even FMCG companies, port operators, all of these will get impacted. So the broad-based impact on profitability on margins. In fact,
Mhm.
the flip side is easier to answer. Which are the sectors where you don't see margin pressure. So I think,
Please
uh,
tell me.
yeah. So sectors where you have largely domestic value chains, fully integrated value chains. So aluminium,
Mhm.
it's fully backward integrated, and because of the global capacities getting impacted, prices going up, domestic manufacturers will benefit. Similarly, edible oil companies, at least the domestic producers, not the traders, could see some benefit, and then the sugar mills as well. So these are the two, three sectors where you have some margin gains, but I think beyond these, I can't think of too many sectors where who will not see a margin decline in the next few quarters.
Even BFSI will take the hit because currency, economy, growth, everything is.
BFSI has a lot of different factors playing out, so I'm keeping BFSI out for the moment. But yeah, I think
Mhm.
with a lag, the impact does flow into that sector as well.
So, what are your growth projections for the FY27?
Right now, we are projecting 6.8% growth.
Not revised since last 2 3 months.
We've revised it down, so we brought it down from 7.1% pre-conflict.
7.1 to 6.8.
Yeah.
So, any periodic revision you do after every quarter or 6 months or like that,
Uh, no, I
or
think
case to
just
case
stay on
basis?
top of. I think as the situation demands, we'll keep re-looking at the numbers if the situation changes. Right now, I think our base cases of the conflict getting resolved in a few weeks, and then if it goes on beyond that, we'll obviously have to re-look at the numbers.
So, the summary is 4.7% inflation for FY27, 6.8 is growth rate.
Yeah.
Most of the sector will be impacted. You expect 2 3 weeks to resolve the issue if it happens every. And if oil prices, pump prices go up, then you will revise your inflation targeting for the year and quarter also. And 2 3 sectors which are immune, otherwise whole economy will be impacted in this scenario. This is the gist of this discussion, right, sir? Anything want to add?
No, I think you covered. I think all our numbers. As the situation evolves, we'll have to keep looking at the situation and see whatever needs revision. We'll come up with revised numbers. It remains a dynamic situation. I mean, it's difficult for anybody to think few quarters ahead.
Okay, Miren, thank you so much for joining us, and very important report and very timely. You are making people aware what is happening in the country and abroad. So we will keep talking to you time and again when you will come up with a new report. Thank you so much for joining us the end show.
Thanks, Neeraj. Pleasure. Thank you.